Ever wonder how a conflict in the Middle East could somehow crash real estate stocks in Mumbai, but at the exact same time boost semiconductor tech in New York? I mean, it sounds like a riddle, right? But it's actually the fascinating reality of our interconnected global markets. When a single macroeconomic catalyst hits, it sends these massive shockwaves across the globe, creating a really complex web of winners and losers. And today, we're going to trace exactly how that happens. Welcome to today's Explainer. It is July 22nd, 2026, and we're looking at exactly how a single economic catalyst can create wildly different financial outcomes around the world. We're going to unpack the precise mechanisms driving these markets, tracking the data step by step as it ripples from region to region. By the end of this, you'll see exactly how global money moves.
Okay, let's dive into our itinerary for today. We're starting with the epicenter, the global oil shock. Then we'll check out Wall Street's tech rebound. Third, India's oil-driven sell-off. Fourth, Europe's inflation relief. And finally, we'll wrap up with Brazil's high-yield defense.
First up, the global oil shock. Look at this number, $95.27. That is the peak price Brent crude hit during this session, and it's basically the number driving everything today. Now, why Brent crude? Well, it's the international benchmark used to price over 3/4 of the world's internationally traded crude oil. So it's the ultimate barometer for global energy costs. You can think of this massive price tag as a heavy stone dropped right into the center of a pond. The sheer weight of this energy premium is creating our global ripple effect, feeding directly into inflation expectations worldwide.
So, what's actually driving this price up? As market analysts, we look at geopolitical events strictly as market catalysts. Right now, traders are reacting to a renewed US-Iran standoff, along with Houthi rebel escalations causing severe disruptions in the Red Sea. And why does a Red Sea disruption matter to your wallet? Because a massive percentage of the world's energy travels right through that specific maritime corridor. When those shipping routes are threatened, the market immediately prices in a supply squeeze, and boom, energy costs skyrocket.
And this acts exactly like a global seesaw. Notice the stark contrast here. Over in India, the Sensex closed down 0.92%. But across the world in the US and Europe, the S&P 500 actually managed to pull off a 0.21% gain, and the UK's FTSE 100 is up a very solid 1.24%. We're seeing distinct winners and losers being created at the exact same time by the exact same barrel of oil.
Number 2 on our list, Wall Street's tech rebound. Now, what's really interesting here is this intense macroeconomic tug-of-war happening in the US right now. On one side, you have this immense AI optimism. We're talking Korean and Taiwanese semiconductor exports absolutely soaring, literally tripling year over year in early July. Plus, companies like Supermicro are jumping after raising their fourth quarter margin view to a highly profitable 15 to 17%. But on the other side of the rope, these tech stocks are fighting the intense gravity of those high oil prices we just talked about, alongside US 10-year Treasury yields, hitting a highly restrictive 4.65%.
And because of those high treasury yields, the US dollar index, the DXY, is holding incredibly firm near 101.20. When the dollar is this strong, it tightly constricts global financial conditions literally everywhere. Capital just gets sucked back into the United States because global investors are flocking to the safety and the high returns of US government debt. This dynamic, it sets up the absolute perfect storm for the financial pain we're about to see in emerging markets.
Which brings us to stop number 3. India's oil-driven sell-off.
715 points. Yeah, that's a brutal single-day plunge for the BSE Sensex. It's a massive drop that dragged the broader Nifty 50 index right below that crucial psychological mark of 24,000. It's a really painful reminder of market vulnerability. You see, for a rapidly growing, oil-importing nation like India, a sudden spike to a $95 barrel of crude directly weakens the domestic currency and massively inflates the national import bill. This instantly triggers a fierce risk-off sentiment, sparking a rapid sell-off.
The localized damage was heavy, especially in rate-sensitive and fuel-dependent sectors. Realty and media both dropped 2.6%, but aviation took the absolute brunt of it. Indigo fell 3.4%, and it makes sense, right? When global operational costs like oil soar, aviation bleeds. Jet fuel can actually account for up to 40% of an airline's total operating costs, so a sudden spike in oil just completely decimates their profit margins. PSU banks also took a significant hit today as the broader market stepped back to reassess the country's inflation trajectory.
But hey, it wasn't entirely red across the board. While sectors like pharma were heavily pressured by proposed U.S. tariffs on imported generic drugs, the FMCG and auto sectors actually held their ground. They were supported by very strong first-quarter earnings from sector leaders. It's just a great reminder that even on a highly volatile, macro-driven day, resilient corporate earnings can offer a steady, safe haven for focused investors.
Moving on to Part 4, Europe's inflation relief. 2.6%. That is the UK's June Consumer Price Index, their inflation rate. Crucially, this is down from 2.8% in May. In a world currently hyperventilating over surging oil prices, this localized data print showing cooling inflation is huge. It significantly cools off the pressure for the Bank of England to maintain or hike their interest rates, giving both consumers and businesses a much-needed breather.
And because of that cooling local inflation, Europe was uniquely shielded from the global oil shock today. The numbers really tell the story here. The FTSE 100 in the UK closed up 1.24%, France's CAC 40 rose 0.89%, and Germany's DAX added 0.58%. Investors in Europe were happily pricing in this domestic economic relief over all the external geopolitical noise, pushing major indices solidly into the green.
Finally, our fifth stop, Brazil's high-yield defense.
To really get what Brazil is doing right now, we need to quickly talk about a concept called the carry trade. This is a massive driver of global capital. Basically, it's a trading strategy where investors borrow money from a country with very low interest rates, like Japan, and invest those borrowed funds into a country that provides a much higher rate of return. They essentially pocket the difference, which can literally mean billions in global capital movement.
Which brings us to 14.25%. This is Brazil's brutally high Selic interest rate. Their central bank has kept rates incredibly high to crush their own past inflation. But for foreign investors, this 14.25% acts as an irresistible magnet. It offers one of the best real yield cushions in the world, meaning the return you get even after accounting for local inflation, pulling huge amounts of foreign fixed income capital into the country.
So, what's the bottom line here? Brazil is successfully cushioning its currency. The Brazilian real is holding incredibly firm, near 5.07 to 5.09 against the US dollar today. They're utilizing that high carry trade appeal to defend their borders from capital flight. But, it is a fierce double-edged sword. While it saves the currency on the global stage, keeping interest rates at 14.25% places a crushing, painful burden on everyday Brazilians and local businesses when they try to borrow money, severely slowing down their domestic economic growth.
Now, as we wrap up this global tour, I want to leave you with a pretty stark warning issued today by JPMorgan CEO Jamie Dimon. He stated flatly that he would not buy equities or long-dated treasuries at current prices, arguing that investors are severely underestimating global economic risks. Between the Middle East conflicts, U.S.-China tensions, and skyrocketing national deficits, Dimon is pointing out the exact underlying fragility of the markets we've just mapped out. We've literally just seen how a single geopolitical spark can rally tech on one side of the world and completely crush equities on the other. The global financial machine is entirely interconnected. So, as these catalysts continue to ripple across the world, the question you have to ask yourself is your portfolio prepared for the next wave? Are you positioned to weather unexpected storms in emerging markets or capture the upside in tech? Thank you so much for joining me for this explainer. Keep learning, keep analyzing, and stay focused.